Good morning, everybody, and welcome to the second episode of Crystal Clear Complex Cases Clinic. It's a bit of a mouthful. I'm Dan Morris, Key Account Director at Crystal Specialist Finance, and we're joined by two very important, very special guests, which don't need any introduction by now because we've done a few of these. But we're joined by Roger Morris, Group Distribution Director of One Savings Bank, and then we've got, again, our in-house tax wizard, John McCaffery from Alexander & Co. So on today's session, for those of you that haven't been on before, it's very much what you want to discuss, really. So there's no set agenda, there's no preemptive questions, there's no format we're following. We want to hear from you. We want to hear what questions you want to ask about the specialist finance world, any tax questions, again, throw them at John because he will just blow you away with his answers and his wealth of knowledge, because we learn so much in every single one of these sessions. It's like a training session for myself and Rog. And yeah, we'll just have some fun. The sun's shining. It's been a month since we've done the last one. A lot's changed. I'm sure a lot's happened with One Savings Bank, with Alexander & Co. It certainly has with Crystal, but it just feels as if the world's a little bit better. Like I say, the beer gardens are open for those of you that have been thirsty, wanted a haircut, the hairdressers are open, the shops are open. So we are slowly getting back to what we know as a normal world. So yeah, definitely feeling good today. Don't know about you guys, but good morning. Good to see you again.
Morning. Morning, Dan. Morning, John. And good morning, everybody else who's logged on. And I'd emphasize what Dan said. If you've got any questions that you want to cover any subject on, please send it across today. And as we have got the wizard on himself, certainly from a tax point of view, me and Dan always learn when we're listening to John.
No, exactly that. So yeah, just a quick catch up, guys. I mean, how's the last month been for yourselves at One Savings Bank? You've been really busy. What are you seeing a lot of? Do you want to talk us through that first?
Yeah, I think there's been some really key bits that have happened in the last month. I mean, fortunately, we didn't have the stamp duty kind of compression at the end of March, though that necessarily didn't make life easier for brokers, because if you think about it, Dan, you know, you were pushed, and I know you helped get an awful lot of mortgage offers out within that time, and those mortgage offers only lasted so long. So it's not like you can just sort of sit back and relax. You certainly can't. With Precise Mortgages, we had the kind of conclusion to what we thought was the end of phase one on Help to Buy, but fortunately that deadline was pushed back. But we still had an awful lot of builders and developers that really wanted to try and get as many of those completions concluded either for their year end or just for what they were contracted to. And we saw a really busy month within the whole Precise Mortgages business across a number of areas, particularly bridging, of which we did, I think, quite a significant amount with Crystal, and that was really good. When it comes to Kent Reliance, we've moved back to 100% of the share of shared ownership. So everyone talks about 95% mortgages, but if you're in the southeast of England, Dan, the affordability just will not allow you to be able to get that loan. Either your income doesn't fit, or the rate at whatever the rate that's been offered just doesn't work out. So shared ownership is a real way of getting back on that property ladder. And also we found within, particularly with Kent Reliance, the 1 year's accounts and working off a projection. So if you I've got someone who's got 1 year and the second year looks much better than the first year because they've written off a lot of expenses, you can use that projected income. And then with InterBay, we've seen an awful lot of real confidence with your semi-commercial and your commercial properties. And I know that there's a couple of people on here today that have utilized Crystal's services when it comes to semi-commercial and commercial, and done them in partnership with InterBay Commercial. And I want to thank you for that, Dan, as well. And we have also got some real important announcements that we're going to announce today, but we'll hold off on that and see what John in the Wizard of Tax world, what's John been up to over the last month, and anything you want to report, John?
Yeah, no, so it'd be fair to say I've never been busier. I think the whole of last year and more recently, people have had time to think, and people have had their minds focused on their mortality, for want of a better word. So I am seeing a lot of people doing planning around inheritance tax, a lot of families with properties looking at succession planning, and also family investment structures. I'm seeing sort of mid-range, kind of like 30s, 40s people looking to plan for the future. The stamp duty holiday is definitely driving people in terms of property investment, and looking again to set up for younger children and family investment type company structures for them as well. There's a lot of activity in commercial property. People are still looking to do transactions. That's mainly on, well, as I say, a lot of property driven work, and also trading businesses. So I deal with a lot of people who own businesses who have property as investments, but also run trading businesses. And again, a lot of it is about succession, an awful lot about succession, passing down wealth, planning for retirement, investing properly, looking out for the future, not only of them, but also later generations.
John, just I find that really fascinating, and I know Dan will as well, and the people who are listening in. So if I've got a portfolio and I've got a big house, and a lot of us have recently, the value of our properties have moved. So particularly whether in Birmingham or London, you know, it's not hard to imagine in 10 years' time your house could be worth close to £1 million. It's possible. Yeah. Or £500,000 or whatever it is, far more than we've ever imagined in previous sense. And if you're in the southeast, it could be incredible amounts. So that IHT is really a new phenomenon that the average working class had never ever imagined. So realistically, if you've got some unencumbered buy-to-lets and a large unencumbered residential, and I die and I want to leave it to Dan, I'm not leaving it unencumbered, am I, John? Because it's got an IHT.
You're not at all. So what we're looking at basically is for a married couple, you're looking at if the value of what you own is worth more than £1 million, you're looking at a 40% tax charge. Wow. on that amount, right? And that's assuming there are no gifts made in 7 years prior to death. So you're right, down in London, the southeast particularly, you can get to £1 million pretty easily. And there are a number of landlords I'm dealing with who, you're right, they've gone through the lives, they've built a portfolio. It's not a massive portfolio by any stretch of the imagination, but you are certainly looking at a pretty steep inheritance tax charge unless they engage in some planning. The problem with the planning is, and it's always a payoff here, the problem with the planning is either you take an inheritance tax charge during your lifetime, on death, or there's a possibility of a capital gains tax charge on the transfer during your lifetime. In some circumstances, that might be worthwhile taking because it's generally cheaper than the 40% charge. It depends on your level of gains. You've got stamp duty land tax to consider as well. But there are options, though invariably it ends up in some tax, usually a smaller tax than the inheritance tax charge, but some tax being paid.
And John, I've just had a text in from one of the consultants who doesn't want me to shout out the name.
Right.
What does it cost, just generally, to actually employ the services of someone like yourself as a ballpark? Because I genuinely, it's hard to, you know, how.
Yeah, no worries. So it all depends on complexity. Basically, Roger, I sell time and knowledge, and there's a charge on an hourly basis for that. So people who are genuinely looking to do some planning, most people like me would give an hour for free. If they're looking just for an hour's advice, then we would kind of charge outright. So mine would be £300 plus VAT for an hour. But I would tend to knock that off the next fee. Now, if we're looking broadly then at some sort of inheritance tax review on an estate, depending on the complexity, that can come somewhere between 2.5 to 5 plus VAT. And then any implementation, there may not be any implementation after that. They may be able to just take that report and go, right, I know what I want to do, and I can walk away from that. Or some people might be just quite happy paying the inheritance tax. But if they do want to do some implementation, so for example, some sort of incorporation or family investment company structure or something like that, again, you're looking about 3, 4, 5K for the tax advice on that. There would be some legal fees on top of that.
Brilliant. Okay, Dan. Sorry, that's the last question I'd ask for one of our bits. What view you want?
No. It's it's beneficial again because, as I mentioned previously, it's learning from everyone, even ourselves in this course. So as much as you've got John, who we can lean on throughout the year, it's brilliant to hear from him, from audience questions, because ultimately it's stuff that we've not thought of or we've not asked before. And I've got another one to come back to you on for a case that I'm actually dealing with at the moment through Crystal. But yeah, I mean, in terms of the last month being for us, it's been crazy. It's been crazy busy. So as much as we've kicked the can down the road from a stamp duty point of view, I mean, last month we had we had a record month for inquiries, applications, and completions, which is just phenomenal. So to see that the business is still pouring in, and throughout April as well, it has continued to pour in. So I think brokers are extremely busy at the moment, because it certainly reflects in our workload in terms of what we're doing. But it's interesting because we are still seeing a huge uplift in terms of bridging finance. So as much as we do have that extension until June, people do still want to complete quickly. And again, you've seen an uplift in business from ourselves, from Precise's point of view, from a bridging finance point of view, because people just don't want to wait. Again, it's not even about the stamp duty. So we've seen a lot of people that just don't want to wait and let life tell them what to do, or let a purchaser tell them what to do and when they can move. And from the chain break point of view, people just want to sell a house if they've got enough equity, move closer to the kids and spend more time with the kids, because they haven't seen them for the past 12 months. And that's been really upsetting to them and distressing. If you are of, say, 60, 70, 80 years of age, your time is precious and everyone's lost. A lot of people have lost people over the past 12 months and realised that, you know what, we haven't got the time. So ultimately, let's chain break this property. We can afford it. Yeah, it's going to cost us a little bit more from a bridging finance point of view, but we can move 200 miles closer to our family, be around the corner. And we're seeing a lot of people that, from an emotional point of view, it makes sense to do it now rather than waiting maybe 6 months for their house sale to go through, because we know third parties are taking ages in terms of, from a legal point of view, getting stuff across the line. So yeah, we've seen a huge uplift in bridging. And also we've seen a huge uplift in the likes of semi-commercial and multi-unit freehold blocks, which again, when we had this webinar last month, you launched a market-leading product for semi-commercial. So honestly, we're doing so much with you on that. But how have you found that product so far? How's the uptake been and the feedback been on your semi-commercial product?
I think, taking as a landlord's perspective, if I'm buying semi-commercial, which at the moment I am looking one on the outskirts of Birmingham, so city centres, if you take London itself, is still heavily compressed. One of the main reasons that London's property prices, rents have fallen and values have fallen is, prior to the pandemic, 1 in 50 properties was done on a short-term let. When COVID-19 came, all those investors switched them back to long-term lets. And what that did was flood the market at an unprecedented level with new properties. People wanted to move out to the peripheral areas. Now in Birmingham has quite a compressed city centre. If you compare it to London, it is quite compressed. It isn't a big, large area. To me, in my sense, Manchester feels more compressed. Birmingham has more of a suburban feel in the way it's been transformed in recent years. And you've got literally, say, 2 miles from the city centre, places like Harborne, but they still be classed as kind of central Birmingham. So if you've got places where you can get 70% of the property is residential, Dan, and you've got good demand for, say, 1-bedroom units, and the ground floor is, say, a hairdresser's or a cafe or a Tesco or Sainsbury's Express, that type of thing, then that's something that obviously InterBay Commercial will look for. But if you've got something which is right in the city centre and it's kind of in an area which was once heavily occupied by offices and those people just aren't returning back, then will that cafe, restaurant, will that really rebuild in the short term? And that's the bit that lenders worry about and investors worry about. Could you turn that property with permitted development rights back to a buy-to-let property is something to consider. But you've got to be really honest, is do you want to be walking off the street level directly into your lounge in a city centre, which the property might be next to a takeaway that's going to be open at 3 o'clock in the morning? So I think you've really got to, as an investor, you've got to think about the property And what you then is worth doing is ringing Crystal and having a chat about the appetite, because if the lender appetite's there, then potentially it's a good buy. But if the lender appetite isn't there on the Crystal panel, Dan, then possibly it's not the right property for your investor to buy.
Yeah, no, exactly that. I mean, again, we, as a lot of people know on this webinar and those of you that don't, we can essentially help any client with any purchase as long as it's legal and as long as LTV is fit. But as you've mentioned, their rate does reflect the risk. So again, if it doesn't make sense to the majority of lenders now out of the market, yes, the options are still there, but instead of paying your kind of 4% plus as you get from these better lenders as such, then you've got your more subprime lenders which will take a look at it, but you might be paying 6-7%. So ultimately, the rate reflects the risk, and then does that then yield enough to make it a viable investment? Now, if it's owner occupied, then that's slightly different, because if it is owner occupied, then therefore there's, I suppose, less risk in terms of actually, do you know what? Will an office want to, or will a firm want to rent this office rather than actually it's your firm, it's going in that office section. So I think there's definitely more available from the owner occupied point of view. But again, if it's still an investment, we can do it. But ultimately, as you've mentioned there, in terms of geographical concentration and where it is in terms of the city centre or not, then the rate is going to reflect that risk.
Absolutely.
We've got some questions coming in, so we'll come back to our conversation shortly. But first question, so Christina, thank you very much for this. Do you assist with restaurants and takeaway purchases, and I suppose purchases of businesses? So, I mean, I'll take this one. So ultimately, yes, we absolutely do. Now, as it stands, hospitality, so restaurants as such, it's not a huge market in terms of who will lend on a commercial basis, because obviously that's the industry and sector that's been hugely impacted over the past 12 months. And obviously there's a lot of businesses which ultimately are going to bounce back, unfortunately. So yes, we can do it. But again, your mainstream lenders, they're certainly not going to be interested in it because there's too much risk. And we haven't really yet seen the full impact of what COVID's going to do to, say, these restaurants as such, because we're not at the 17th of May yet, which when you can start eating indoors, and a lot of them can potentially open back up. So yes, we can do it, but you're going to be at the higher end of the rate scale in terms of maybe 6-7% interest rate. But again, that's a solution for the client. So if it's right for them and it's the only solution, we do need that solution to make that purchase, refinance, whatever, then we can absolutely do it. Takeaways, a little bit better, because again, they've traded throughout the full pandemic. And do you know what? If you look at the Just Eat figures in terms of the number of takeaways this year, it's phenomenal. It is absolutely phenomenal. I mean, Roger's been a big part of that. As I, and then no, John, I don't think John has, looking at his slim face.
No, I got a Christmas card from my Just Eat delivery guy.
Honestly, well, mine knows to be quiet because the little one's in bed, so they creep through the gate. So it's phenomenal. But if you look at Just Eat, how much they've actually made in terms of profit this year, and the likes of Food Hub and all these local kind of Just Eat imitation apps, so to speak, then absolutely. So yeah, back to, sorry, I digress. Back to takeaway purchases. Yeah, absolutely. It's same as supermarkets and mini marts. They've traded throughout the full pandemic. They've got really good accounts. So again, it's going to be far easier to do these purchases and even purchase that business than, say, the likes of a restaurant who may have dabbled in a takeaway service, so to speak. I don't think you'll have any more comments on that, any of you, but feel free to
surprisingly, yeah.
Yeah, John always does.
Don't worry. It's for landlords, actually. It's how you make your deal better when you are, say, doing something like a restaurant or a takeaway or something like that. So I come across a lot of transactions and advise on a lot of transactions around restaurants. Restaurants are pretty simple businesses. You've got basically, you take a lease, you fit out a premises, and then you sell your product. Yeah. And within that, there's a lot of often incentives given by landlords to try and get tenants in for a period of time. Restaurants are particularly difficult business, and you want them there for quite a while. So you do things like you will often give a contribution towards fit out, or you will do a rent-free period or something like that. All right. So just a quick comment on the fit out. If as a landlord you make a contribution towards fit out, there are certain things that qualify for tax relief for your tenant, and there are certain things that don't. So anything you pay towards structural alterations is more beneficial towards your tenant because they don't get any tax relief for that. If they have to spend money on fit out, they want to spend it on the stuff that they're going to get tax relief on: tables, chairs, kitchens, bathrooms, that kind of thing. Whereas there are things like wall paneling, installation of certain things, does not get tax relief. So it's worth having a quick chat with somebody whilst negotiating that deal, because you'll attract a lot more tenants if you, as a landlord, are aware of the tax reliefs available.
Wow. And all I would put, Dan, is I agree with takeaways. I think have boomed in this area. The concern will be how quickly will we return to restaurants? Will the demand for restaurants be equal to pre-COVID levels, less than pre-COVID levels, or will there be even more? Because people's social habits and you know, if you look at the French, they eat out less than what the English do. Will that change? And it's that concern over restaurants and the saturation in areas of restaurants that give lenders concern. But takeaways, I just think is a different concept. But again, John surprises us. Dan, what's the next question? Because I've seen a really good one coming in from Karen Phillips.
Well, we'll get to Karen's in a second. So that is the next question. So we've got Claire. So thank you very much for your question, Claire. So a second home for family to live in, are there any tax advantages? So
wow. John, straight to you. You can have that one.
No, not really at all. So let's assume it's a married couple with family, okay?
And you get main residence. So if you sell your main residence, there's generally not tax on it, presuming it's been your main residence throughout its life. If you have a second home for your family to live in, that second home will not get main residence relief unless it ends up being your main residence, which is all a matter of fact. If you've got a couple of properties that could be your main residence, then you can elect within 2 years of acquiring the second main residence to decide which one would be your main residence, and you would generally go for the one you think you're going to make the bigger gain on. It's not a tax advantage. If you've got a second home or a holiday home, which we may be coming on to, you can rent out the second home. The income you get from that would be taxable, but there are certain benefits to holiday homes if it's structured in a particular way.
Brilliant. Which, yeah, we'll come back to that later on. So thank you very much for that, John. Right. Okay. So Karen, coming on to your questions. We got Karen from Green Shoots Financial Limited. It's as if this. What shall I say on this question? Let's just say we've got a certain new product which is being launched live as we speak right now. And Karen, this is thanks to your question and opening this up. So I have 2 separate clients looking for holiday let finance potentially. Can I have more information, please? Well, Roger's about to make a stretch, I imagine, to afford behind him.
I just think, Karen, your vision and focus is just incredible. InterBay Commercial has just launched our holiday let product, and let me give you some real solid information.
Market leading holiday let product.
Well, I can't actually use those words, Dan, but I wouldn't necessarily argue with you. The holiday let market's not colossal, it's not huge. You know, there's something like 4.5 million buy-to-let properties in the UK. But according to David Byers in the Times, that he wrote an article on 27th of March, there's about 56,300 registered holiday lets in England, and that's up from 50,960 in 2019. According to Sykes' holiday let report, is our staycations were rising dramatically from the hot summer in 2018 and 19. So people say holiday lets are all about COVID-19 and it's going to be short term and then people are going to go back to Spain. Well, actually, no, that's incorrect. In 2018, 2019 saw a huge rise in people wanting staycations, with the average UK individuals having at least 3 staycations a year. The number 1 top town for a staycation in the UK using a holiday let is Whitby. which I think is really incredible. And then we go down to Devon and Cornwall to Salcombe and beyond. Now, think of this, Dan. Everybody is looking when they have a buy-to-let, how do you get the maximum yield? So imagine you had a street house in Burnley or a street house in Hartlepool. If you put a jacuzzi in the backyard, would you increase the rent by 56%? No, not a cat and hell's chance. But in a holiday let, apparently it does. So when we look for a holiday let, apparently we look for a 3-bedroom property that will allow us to take our dog. And Dan, as we know, we'd like a secure garden that we could let our little poochies out on the morning without necessarily getting dressed, that they can't disappear and chase sheep. So not only do we want a garden, we'd like it secure. We'd like Wi-Fi just to keep the teenage kids and the little ones happy. We want a high chair, apparently is another feature. And the other one is a log fire, though there is that focus on our carbon footprint. So InterBay Commercial launched. We've got a 70% max LTV. We've got a 2-year fixed at the 2-year fix is at 3.84 and the 5-year fix is at 4.29, both with a 1.5% fee. And what we're looking at the moment is we want an application of a joint income on that application or a combined income of just £30,000. And we can obviously buy it in personal ownership. John will give us a quick overview on Section 24 and how this is exempt. But what I would say, Dan, with InterBay Commercial, what I think we stand out from the crowd on is we'll do them in a limited company. Now, when we say we do them in a limited company, it's got to be an SPV, specific purpose vehicle. And we allow, or we have a maximum of 4 directors. We do not ask for PGs on shareholders, even if they're more than 25%. And you can have shareholders being other businesses. So you could have Roger and Dan Electrical could in effect be 100% shareholder in that SPV. And we're very happy with intercompany loans. So you could have Roger and Dan Electrical do an intercompany loan to the SPV as well. So I think being able to do it in a limited company is another area that I think InterBay Commercial has that bit of an edge. So a lot of exciting things, I think, to launch. And to understand a holiday let is classed as a business, and the tax side, I think we need to go live to our Manchester studio and get a viewpoint from John.
Right, there's a lot of information and a lot of techie stuff around holiday lets. You're right, they do, if they meet certain conditions, qualify as a business. And what that means is that the capital gains tax treatment is favourable. So if you qualify as a finished holiday let, and it has to be furnished, then on a disposal of that business, under current rules, you are entitled to the first 10%, so the first million at a rate of 10%. Or if it's a company, you're entitled to the first million on your shareholding at a rate of 10%. Now that can be several people, as you said, has to be individuals. So companies tend not to get that benefit, but they would benefit from other reliefs that are available. Right. And to qualify, the furnished holiday let must be based in the UK or the European Economic Area. I imagine you would prefer it both in the UK.
Yeah.
And it's got to be available for let for, I think it's 240 days a year. Right. You must actually let it, I'm referring to an earlier conversation this week, Roger, you were correct, for 105 days a year. And you can't let it to the same person for a period of more than 31 days at a time. Okay? There are certain elections you can make if you don't meet that criteria in 1 year. You can average it over a couple of years. Okay? But provided all those conditions are met, they were, and the other thing is it's as I said to earlier, it's furnished. It's got to be furnished, and it's got to be furnished to a standard whereby people can use it as a furnished standard. You qualify for the favourable capital gains tax treatment. Now, what that means is, as I say, 10% rate on a sale.
It also means that if you wish to gift it down the generations, there's a relief available, which means you can pass it on without paying any capital gains tax on it, and the person who receives it would pay the capital gains tax when they sell it. Okay. A few other things to be aware of with furnished holiday lets. If you're doing furnished holiday lets, and I think I mentioned this last time, if you are providing other services, those other services are potentially subject to VAT if you are providing sufficient other services that you break the VAT threshold at 85 grand. So you need to keep an eye on the other services you're providing. Secondly, and this is a bit of thing, I think there's some confusion out there on this. Generally, furnished holiday lets won't qualify for relief from inheritance tax. Now, certain businesses, a lot of trading businesses do, and it is classed as a business, but your services would have to be worth over half the value of your business rather than the lettings part of your business to qualify for inheritance tax relief. And that is very rare. There's only 1 or 2 cases that have actually been won on that case. And the other thing of interest with furnished holiday lets is that the income is classed as taxable earnings for pensions. So most landlords have difficulty making pension contributions because rental income doesn't qualify. But rental income from a furnished holiday let does qualify and should enable you to make pension contributions should you wish.
Brilliant. Thank you very much.
And I think that's a huge thing, is in the fact that whatever profits I'm making from our buy-to-lets, we can't put into pension contributions, but a holiday let you can. You got your capital gains allowance.
A little bit, Rog. As you personally can't make pension contributions if you've got your property portfolio in your own name. If you've got a property portfolio in a company, the company generally can make pension contributions on your behalf.
Wow, that's another great point to incorporate. The fact that the profits can go into a limited company, but in personal names you can't. And I didn't realise that point, John. Learn again. And I think the capital gains bit. So Dan, if we bought a property in the Lakes and we rented out on an AST and it went up by £1 million, we'd pay £280,000 in capital gains. But if we ran it as a furnished holiday let, we'd only pay 100. So again, another huge point, but I definitely see it as a great bit. And then business rates, because it's classed as a business, if the rateable value, apparently 96% of holiday lets are classed, don't pay any business rates. So if you take a typical property in Windermere, sort of a high-end one, you might pay around £4,100 a year in rates if you had it as a residential home or a standard buy-to-let. But because of its rateable value, and you can find the details out on HMRC's website, you wouldn't pay any business rates or any standard rates at all because the rateable value is 12 grand or less. So it's understanding the benefits of a holiday let. And with InterBay commercials criteria, we don't mind, Dan, if you actually use that for a holiday for up to 60 days in a year. So another good reason. So you can contribute to your pension, you can use it in unoccupied times, you don't pay council tax, and statistically you're not going to pay council business rates. Your profits can be put into your private pension. You've got a bigger potential capital gains allowance. So there's a lot of good things, but again, it's certainly worth speaking to John before purchasing one to make sure it's structured right in the beginning.
Yeah, no, absolutely. I mean, coming back to your point you mentioned about 30 seconds ago, that's a phenomenal bit of information, a nice little golden nugget that can occupy for up to 60 days, which for a lot of people, that's absolutely what they want to do. But ultimately, there's not many or any products out there as such that'll let you occupy that property on, I suppose, a non-regulated basis yourselves. So I think that will set this product apart from the rest, because I've had so many people who came to me and said, right, clients looking to purchase a holiday let, it's going to be down in wherever, Dorset or wherever. Can they occupy it? Well, no, ultimately not. And unless they go down, say, the regulated route, which then we look at the full income and affordability. And actually, do you know what? The figures don't stack up, so to speak. So no, that isn't available. So an anonymous attendee just said, is the borrower allowed to occupy the holiday let at all for any period of time? There you go, up to 60 days, not a problem within that year. John, I know you're going to chip in a second because I can see your mouth's about to go. Is there any tax implications if the clients were to do so?
If they hold it in their own name, no. If they hold it in a company, they either have to pay rent or it would be treated as a benefit in kind and they'll be taxed on the rent equivalent.
Wow. So just to clarify that, do you know what, Dan? Every second is a school day with this guy. So what we're saying, I'll answer the question at the same time because somebody's come in. Is it available for Wales and Scotland? So our product is only available for England and Wales. It's not available in Scotland. So me and Dan, we buy a holiday home in, let's say, Bowness, Dan, because we both love Bowness.
Stop teasing me.
Is what? Stop teasing me. Yeah. So me and Dan, under InterBay's policy, are allowed to go there 60 days. So we have it in our personal names. We go there for 60 days, max. From a tax point of view, we seem to be okay on that.
Yeah,
but if it was in a limited company, we wouldn't be allowed to do that because it's a benefit in kind and that wouldn't be acceptable.
You can do it.
It's just as a tax charge. You're absolutely entitled to do it. It's just as a tax charge.
So what we'd have to pay the business?
Basically, you would be deemed to have benefit in kind equal to the rent you didn't pay.
Yeah.
Because you're a director of that company.
And we just have to pay the tax that would have.
And national insurance.
Yeah, so there's different pros and cons of having an individual ownership as opposed to limited company ownership, isn't there? So again, that's where you come in terms of giving that specific tax advice to see which is going to be the most beneficial for the clients given their particular circumstances. Yeah.
Yeah.
God, that was just worth it itself. Dan, we're going to buy our property in Bowness in personal names at the moment, but then again, John's going to speak to us afterwards. But
no, you're not.
So we answer that one again. We've learned that one.
That's brilliant. Thank you very much for that question, or them questions, so to speak. So again, John, another one for you, just from a case that I'm dealing with currently. So there's clients that are coming to me at the moment where there's portfolios that are currently owned in limited companies, right?
Yeah.
Okay, so let's say we've got one ongoing at the moment where I've had an inquiry come in and there's a block of 21 apartments inside, a block of 21 apartments held by a limited company.
Yeah.
Now, this particular client wants to buy the limited company that holds the properties, obviously to essentially mitigate or get around not paying the stamp duty as such.
Yeah.
Purchasing it in this way, so purchasing the limited company that holds the properties, regardless of lending and such, what costs are involved with that transaction?
All right, so there's a trade-off there. There's an absolute trade-off there. Okay, so you can do exactly as you said. They can purchase the shares, right? And they will pay 0.5% on the value they pay for the shares, right? Now, another benefit to that structure is, let's say the transaction price was 2 million, okay? But the properties have got 1 million of debt on them, okay? So what they can do, for example, is you purchase the shares for 1 million and you use the other 1 million to pay off the debt, thereby saving even more stamp duty at 0.5%, 50 grand saving on the stamp duty, 550, yeah. But the issue with buying a company is you buy the history of the properties, okay? So let's say that property was purchased for 1 million. If the company ever sells that property, it can only deduct the 1 million despite you having paid 2 million for the shares.
All right, okay.
You're buying the gain, you're not washing it through.
Okay, that's interesting.
That's the trade-off. It's kind of, is my stamp duty saving now worth more to me than potentially paying a larger capital gain down the future? The other commercial point to note on that is you buy the entire history of the company. So you buy the creditors, you buy the debtors, you buy the problems, okay? So it's a bit more expensive because you want to actually look into the history of that company, do full due diligence on what you're buying. Whereas buying the property, you know what you're getting.
Perfect. No, that's again useful for me to know, because I've had that a few times recently because clients are trying to be savvy in terms of the way they're purchasing and the actual ownership structure. So that's brilliant. We've got another question that's just came in. Roger, I don't believe it's one for you, but can you arrange holiday let finance or buy to let finance on one of the Scottish islands that don't have a bridge connecting them to the mainland?
So let me just pick up on that. So the problem you've got is most of the lenders in the holiday world are predominantly to England and Wales, and there is a restriction to Scotland. And with Scotland actually features one of the lowest areas for tourism on the actual scale of where the demand is. If you actually look at the map of the UK as a whole, where the hotspots are, it's Cornwall because it's warmer. It's North Wales, not South Wales. South Wales is much further down the list. And then it's the lakes, then it's North Yorkshire. North Yorkshire, or Yorkshire itself, hits twice in the top 5. But in Scotland, it does reduce. When you look at Scotland for its main tourism is actually the southern areas around Glasgow and around Edinburgh, around Stirling, that kind of southern belt. We know from the holidays we've had. But when you go up to the sort of particularly the west, and you look at the islands out there that are predominantly serviced by ferries, that we've been on a number of them in the years, Dan, there's a big restriction as to who will actually lend on them. And it's very bespoke as to what you can do. What a lot of the times is if you're dealing with an average landlord who's got, say, 8 buy-to-lets and wants to purchase one, sometimes it can work out cheaper and easier of refinancing that portfolio with Crystal, looking at whether, and even looking at capital raising on their residential. This is just purely from a mortgage point of view, John. You might have some reasons of not doing it that way, but to actually raise the money on some of these places, it can become a much easier option, Dan.
Yeah, no, absolutely. You know, that's right, because you're going to have less hurdles and there's going to be more appetite and more lenders within that marketplace, really. I mean, in terms of ourselves, so we can arrange finance on a buy-to-let basis on any of these smaller islands. Obviously, again, the rate's going to reflect the risk, as I mentioned at the very beginning of this webinar, but we can absolutely do it. But you're probably looking at north of 5%, so to speak. From a holiday let point of view, we can look at it, but again, it's going to be on a referral basis only, and chances are it really depends on, is it a trade and holiday let at the moment, or what does it look like in terms of clients visiting that island and footfall and all that sort of stuff. So it's a possibility. So again, as I mentioned previously, anything's possible within the specialist market. That's the beauty of it, from a common sense approach. But ultimately, does it make sense? And again, rate reflects the risk. Did you want to chirp up, John? Or are you quite content with that?
Good on that
one. Right. Okay. So from registration, we had quite a few comments on the points that brokers are seeing a lot of declines for the self-employed. Rod, do you want to cover off anything on that in terms of why? So you may be your firms may be declining more and more self-employed, and for what reasons, and so how we can overcome them and better package a case up so it's got more chance of being accepted.
Yeah, absolutely, Dan. So if we actually look at the high street as a whole, is declining a significant amount of self-employed customers. In January 2020, there was just over 5 million people classed as self-employed in the UK. And COVID-19, when we saw the increase in unemployment, saw the self-employed numbers drop to about 4.5 million, though that's expected to rise. So when dealing with a self-employed case, we really do excel at both Precise Mortgages and Kent Reliance. So if you've got a self-employed customer that went sort of self-employed just over a year ago, they got 1 year's accounts, they maybe have loads of unsecured arrears because they had a little bit of delay in getting paid, but they're back on track, then Precise Mortgages would consider somebody with 1 year's accounts and unsecured arrears. But what we're really looking for is a correlation of the latest 3 months bank statements reflecting the income in the accounts. So if you're on 30 grand a year, let's see the income coming through that proves that income is still there. And more importantly, a letter from the accountant to actually give a view of since the accounts have been done, that they've had a look at the income and they're happy to confirm that income remains the same or more buoyant. But if you've got somebody who's, say, the first year after write-offs maybe declared a 30 grand's worth of income, but this year looks set to hit 50 or 60 grand. If the accountant's prepared to give us a projection, we could potentially look up to 30% increase on that first year's figure. So again, it's about understanding. But my top tip with the self-employed, both Precise Mortgages and Kent Reliance will do 1 year's accounts. What we want is an accountant's letter, if possible. You don't have to get it. It just adds a lot more weight. And most accountants will happily write some form of supporting documents to support the application, but a covering letter from the broker explaining that this particular individual has traded through COVID-19 absolutely fine, or these are the problems they've had, this is their current position, and look at their income. And if they did have a, say, dividend in that first year, Dan, shows the bank statement where that dividend was given, because that's sometimes maybe only given once in a year. And remember, we can add things back, like in a limited company director, say if they contributed 10 grand in the private pension, we could potentially add that back as income, and maybe a car allowance as well. So we're very much open for business when it comes to self-employed.
Yeah, no, brilliant. Thank you very much for that. I mean, just to touch on from myself and our point of view, I think it's fair to say, one, it's very important how it's packaged and how you tell the stories to the self-employed, while there's been a downward profit term, while there's been a loss, so there's a reinvestment into the business or whatever that may be. But I think a lot of it does come down to how it's packaged. So if it's maybe a case that you are, I suppose, not so confident that it's going to go through, and it could be beneficial speaking to ourselves again as to helping you package that case up, send it to a specific lender and actually understand their process, and maybe have a better chance of getting it through, because we understand and know that particular lender's process and what they want to hear, see, and obviously legally and genuinely, but just putting it in a way that they understand it and want it. Now, we have seen quite an uplift ourselves in terms of the self-employed getting declined, and a lot of it does come down to the bank statements and the past 3 months bank statements. So if you've got a cash business, let's say you've got a skip hire business, which is one we've done recently, the statements up until December wasn't showing much in terms of income. As much as the accounts showed that they were getting, say, 40 grand a year, 50 grand a year, they weren't showing any income in the accounts, because actually, the cash that they were getting, even though they were going to report it as earned as such, they were just keeping and living off it daily. Now, from a lender's point of view, if they look at the accounts, regardless what an accountant's letter, projection, whatever shows, if you can't prove that income because you're living off it and doing your shopping or putting your petrol in or that sort of stuff, then unfortunately, the letter from the accountant's worth nothing, because there's nothing to back that up. And that's almost self-cert, so to speak. So just make sure, if your clients are self-employed, get paid cash, they do put it through the business and gives them the best possible chance. Now, luckily for that particular client, when we went back to them, say 2 months later, they'd actually proactively been putting the money into the bank account so they could reflect the earnings that they had projected. So we saved that client from, say, getting repossessed, but ultimately just make sure that they are paying that money into the account. John, anything from you?
Yeah, I kind of look at it from the other side. There's a bit of a conflict between what you require and what I advise in terms of people handling. It's much more tax efficient from my point of view for people to, if they don't need the funds, to retain funds in companies because there's a lower tax rate. And also, if they are able to spread their income around their spouses. So, for example, a chap earning a salary on 100 grand is going to pay a lot more tax than a married couple earning a 50 grand dividend each. Significant amount more tax. I quite frequently get requests for mortgage brokers, and I have to say, I when I'm dealing with mortgage brokers, I go to the mortgage brokers who put a little bit more work in and look at the wealth of the individual, rather than just saying you need to show earnings of X. You don't need to show the earnings are. I've got clients who are incredibly wealthy with cash available to them, but I'm telling them not to take it out because it's an unnecessary payment of tax. So the clients themselves need to keep decent records.
but you also need the brokers to dig in to the tax returns, to the accounts, to the wealth behind that, and put a proper case forward to the lender. I appreciate some lenders are black and white, but there are sufficient lenders out there who, with the right information, would lend. A lot of my clients, a vast amount of my clients, are self-employed in that regard. And so, yeah, just comments from my side, really.
Great. No, thank you very much for your comments. So again, it's just about linking up with a decent tax advisor like John and just making sure that you're doing something that is going to benefit you and it's not going to be a hindrance to you. So again, we know all these people who are tax savvy, but actually when it comes down to a lending point of view, they haven't declared the income that they need for the property, and therefore it kills the case straight away. If you've got any more questions, can you please ask them now? We'll be wrapping up in a couple of minutes. But we do have another question that just came in specifically for Roger, specifically for InterBay. So how many years accounts for semi-commercial do you need? I also noticed that even a small residential unit in a commercial building, InterBay treats as a semi-commercial. Is that right?
Yeah, perfect. Right. So the first question is, we request 1 year's accounts as a minimum. But what you've got to think about this in this context, Dan, is the following: is it's not just you as self-employed. So let's say, Jan, you're a self-employed delivery driver under contract for a large international web-based company, and you want to buy a factory, we want to buy a big warehouse to store your stuff in, and you've been going a year or 2 years, you've got good accounts and you meet the criteria, then that's fine. But if you want to actually buy, say, a semi-commercial property, for example, and maybe downstairs is a takeaway, then it's understanding how that business has performed, regardless of how you've performed, unless you want to take it up as kind of, so it's a kind of bit of what's that business doing and what's your business doing, and what are you going to do with it? In other words, you're getting a semi-commercial, and downstairs is a brilliant takeaway. It's run by John and it sells kebabs and God knows what. And John's booming. He's virtually 24 hours a day. So that semi-commercial will be, John's been in there, he's been in there for 5 years. He's just taken another 10-year lease and there's never been a problem. And the flats upstairs have always been rented out with no gaps. So you've just got to meet our criteria for the income behind the scene, because the actual rent roll on the building will cover our servicing requirements. So it's kind of understanding what it is that you want. But when it comes to why does a building be classed as semi-commercial, even though the residential part is very small? Well, that's to do with legislation of the 2004 Housing Act that defined 4 types of property in the UK: residential, HMOs, semi-commercial and commercial. And semi-commercial is defined under law by a property having human occupation, residential, sort of, you know, a small 1-bed, 2-bedroom flat. And the moment you've got that, that's how it's classed. So it's the 2004 Housing Act, section 254, I think it is, which is page 196. So I think could be 197, John.
No, thank you for that. Thank you for that. And just quickly, what's your stance from a group point of view on rent arrears? So let's say there's been rent arrears over the past 12 months due to the pandemic. People have lost their jobs. As much as the client's still the client's still been paying the mortgage, say taking money out of the SIP, etc. But the clients haven't been paying because they've lost their income. What is Precise's stance as such on rent arrears?
Yeah, well, Precise and Kent and InterBay is down to this. When any lender now deals with a landlord, Dan, they need to look at what capital they've got just in what happens. So we like to see 3 months. I think landlords should have 6 months cash to cover rental voids right across the portfolio. Now you'd say, well, that's never going to happen. And if you've got a big portfolio, it potentially hasn't. If you've got one property, then potentially it could happen. But when you see life once in a 100-year situation like COVID-19, where the landlord hasn't got the ability to draw down funds from offset accounts, hasn't got any form of investments, cash, liquidity, or saving, creates a problem. And there's a bigger problem because they were unable to cope with that situation. By helping them further, another problem could come around. And the regulator is very clear on stopping possessionary positions by actually using bridging and other bits. You're better off just letting the customer let fate take its course. But with us, we wouldn't lend to anybody who's got arrears in the last 12 months. What we'd have to do, it has to be longer than that. So you want a status zero through the last 12 months. But according to whether it be residential, buy-to-let, semi-commercial, or commercial, it just depends. My advice, contact Crystal, speak to the help desk, and work out what lender on the Crystal panel is the right solution for the customer. It's certainly not within our group because there's so much more choice out there. And I wouldn't want people to think we're the only ones that do it, Dan.
No, brilliant. That's perfect. Yeah, thank you for that. Because I know we do get a lot of questions around rent arrears as such. So yeah, speak to us and we should be able to find a home for your client's case. Before I wrap this session up, which again, it's been a very engaging session, so thank you very much for everybody joining. Is there anything from the Wizards or yourself before we wrap up, guys?
John?
You want me to? No, it's over the last few of these, and I know it's kind of like, talk about tax and it's very kind to say like the Wizard kind of stuff. And when you're doing transactions or when you're doing property, and I know I'm here kind of like because there is a service to be had. Tax can be an enormous hidden cost. So if you're not fully informed of what you're doing, you might find that actually all your plans come unstuck with the tax bill. And it's just the reason I'm on here and the reason I'm talking about this is actually think a little bit about that and factor in that cost into your planning. If you don't, you'll come unstuck.
Yeah, I think every recommendation needs to have someone like yourself alongside it, just to make sure that there is that appropriate advice that's given, because as we've seen over the past couple of years, there's a number of advisors and brokers that have been made examples of by the regulator due to the fact of being perceived to being given tax advice. Now, I could give information to someone, but I'm not a tax advisor, and that could be perceived by certain people as giving tax advice. So it's best off that advisors, unless you are suitably qualified, stay away from even touching on the tax subject and speaking to someone like yourself from a client's point of view. And that's not to plug you business at all, as much as we like to give you business and clients. It's about safeguarding your own business as a mortgage broker. You focus on ultimately mortgages and your general insurance products, whereas obviously you're in a completely different field as such. So again, if I can stress anything to anybody on this call from a tax point of view, link up with someone like John or even John himself and just make sure that your client does have all the bases covered, does have all the costs worked out, because if they get down the line, get to legals as such, and actually there's another cost or implication, or actually when they've been trading in that SPV for a year and they realise we've got a cost that we haven't thought of, then again they'll probably come back to you as an advisor and kick off because it's not been something that you've made them aware of, even though it's not your remit. So yeah, link up with someone like John. Anything from you, Rog?
No, I was really saying, guys, if you've got any form of mortgage related property inquiry and you really want to get a comprehensive view, and for your fact finding, your research, there is so many lenders with so much criteria, and it's who does what and what happens here. It's bad enough with the three that I've got to remember. Make a call to Crystal, speak the help desk, get to know the team. Their job is to go and research the market and help you make that informed decision, because I, like I say, struggle to keep up with 3 lenders' criteria. God knows what it's like keeping up with 80. You've got a tough job out there. Pick your partners. Pick Dan for Crystal. And again, when it comes to wanting to have someone to partner up with tax, you could go off and have a coffee with John virtually, see whether or not that's another direction you want. But Dan, thank you for today. We've had an immense session, and looking forward to the next one that we've got in May.
That's it. Yeah, no, the series continues. The 3 amigos continue, and yeah, no, thank you very much for a great session. As Rog touched on there, honestly, if you do have any cases which ultimately you are struggling to place, or even think, where the blooming hell do I go with this case? Am I wasting my time? the sourcing systems are brilliant, but actually you may want to speak to an underwriter, which again, we've got specialists in every single area. You can hold your hand with cases, and ultimately we can help you find a home for that case, or ultimately tell you that, you know what, there's nowhere in the marketplace that can place it. Don't waste your time on it, because again, your time's money. And obviously, as I mentioned in every single session, we will not be beaten on bridging finance. If your client is looking for bridging and you've got any lender in the market, even the likes of Precise, who have some fantastic products, come to me, say, Dan, I've got these terms, beat the rate, pay me more, or shave the fees or whatever. As long as I've got legitimate terms to compare it to, I will always beat it. We have never been beaten on bridging finance in my many years at Crystal. Have we got another question that just came in quickly? No, thank you, very helpful. Yeah, brilliant. No, thank you for your questions and comments. We'll sign off now, so have a fantastic day. Enjoy the sunshine. If you're going to a beer garden, I'm jealous. If you've got any questions, you'll get an email after this with all of our contact details on, so please email, call, what have you, and get in touch, and hopefully you will sign up and register for the next session, because again, we find these useful. Hopefully you do. Have a fantastic day, and God bless.
Take care. Bye,
Thank you.
guys.
Bye.